My name's Tung. I've been married 16 years and I've got 2 children. My son's 13 years old and Darcy, my daughter, is 8. I work in corporate strategy and innovation, and I look at long-term trends and I help translate what those trends means for impacts to organizations. So a few years ago, we'd accumulated a reasonable amount of capital, and what I wanted to be able to do was try and figure out the right asset allocation to structure that portfolio. And I went out and I spoke to financial planners, stockbrokers, accountants, private bankers, a whole range of people who I thought were experts. And the advice that they gave me weren't all that good. Basically, they told me to put more into property and more into shares. And from the analysis that I saw, those asset classes were actually quite peaky, quite bubbly in terms of where they were in the market. And so what I did instead was I invested a good 18 months of my time, and I read 40 or so books about the economy, about different asset classes and investments, and I educated myself in terms of how to best manage the money for my family. The books were absolutely fantastic, but they provided a very US-centric context, and I really couldn't find someone who I could talk to in Australia about these sorts of things. And the advisors that I'd spoken to, the accountants, the financial planner, the private bankers, all gave me the very vanilla perspective that didn't really relate to my particular circumstance. And I was watching this one blog on YouTube, and quite funnily, it was an American analyst interviewing an Australian chief economist, and I thought, that's great, he's in Sydney. So I picked up the telephone, called him up, and he was happy to meet me, and that's how I met Jordan. So Jordan's an author of a fantastic book, and the book is called Money for Nothing, Debt for Free, and it's a really good book that talks about the global macroeconomic situation, but what he does better than anyone else in the market is he distills that down to what that means to Australians. Because I believe that we're about to enter a market of increased volatility, we've put together some material that Jordan's going to walk you through right now that talks about the global debt levels and what that means for you and the impact that will have on property prices in the stock market.
My name's Jordan Alicio. I've been fortunate enough to work in financial markets for the better part of 20 years, spending a lot of time in both Sydney and London, working for companies like JP Morgan, Deutsche Bank and AMP Capital. And over that time, I've been fortunate enough to see a lot of very interesting developments and trends develop in financial markets, which are really important for people to understand when it comes to putting together their own portfolio of assets now. And I think the best way to understand how to build wealth in the coming years is by understanding how people's finances are structured across the economy and the current state of financial markets. And what we then need to look at is what is actually happening in the economy, both in Australia and around the world, and marry those two together. Now, for most Australians, the biggest assets that they've got are their family home, their superannuation, and of course money that they've just got saved in the bank, with latest research suggesting that pretty much 90% of people's wealth is held in those places. And the family home is by far the largest component of people's wealth in Australia, pretty much accounting for half of an everyday Australian's wealth. Now, whilst rising house prices have helped people build equity in their homes over time, they've also had to borrow a lot more money. And to put it in context that people can understand easily, the ratio between what people were earning and the average house price back in 1985 was just 3.4 times. So if the average Australian was earning $100,000 a year, then the average house sold for about $340,000. Today, that ratio has hit about 11.4. So if the average income for an Australian was $100,000, then the house now costs well over $1 million. As a result, even though interest rates are at record lows today in Australia, most people here are spending a larger percentage of their income paying for their mortgage than they did back in the 80s and 90s when interest rates were well over 10%. Now, this is a major problem. Firstly, it means people need to save much more just to build a home deposit in the first place. It also means once they've bought a house, or in fact even if they're still just renting, they're having to dedicate a larger portion of their money just to putting that roof over their head. And of course that leaves them less money either to spend elsewhere or to save or to invest in other productive enterprise. It also means those that actually have a mortgage live in pretty much perpetual fear of interest rates rising sometime. Superannuation is also one of those things that's going to be at risk in the coming years. And that's because the majority of the money that people have in superannuation is invested in things like the stock market and in fixed income investments. So either ownership of listed companies or loans that have been made to big businesses and to government. And the reason that that's a problem going forward is because these markets, especially those fixed income markets, are trading at some of their most expensive valuations in history. And as we all know, markets don't go up in a straight line, and that's what the global financial crisis taught people when we saw stock markets and the like crashing by over 50%. As a result, going forward, there could be some quite significant losses in the years ahead, especially when we consider the unresolved challenges that we're facing in both the global and the Australian economy. When we look at the Australian and the global economy, there are two major unresolved challenges we're going to have to deal with in the years ahead. The first of those is the aging population. Now, this is going to be a problem for a number of reasons. Firstly, what it's going to mean is that there are going to be less people working and actually paying taxes into the system. Secondly, it also means we're going to have a lot more people claiming things like the age pension, as well as using our free healthcare system. And to give you an example of how these demographic forces have changed over the last several decades, consider that back in 1950, there was roughly 16 people working for every one person that was actually a retiree and would have been claiming the pension, free healthcare and the like. Today, there's barely over 3 workers for every retiree, and that number continues to fall. So, if we assume, for example, that every retiree required $100 in government spending a week, then back in 1950, when there was 16 workers for every one retiree, each and every worker only needed to pay about $6 a week in tax so that retirees could claim the pension and the subsidised healthcare. Today, each and every worker now needs to contribute over $30 a week in taxation just to keep the system going. Going forward, this is clearly unsustainable, and in fact the government's own modelling proves this, and it indicates that over the next 25 years, growth in spending for things like Medicare, Medicaid, Social Security is going to grow at between 2 and 3 times the rate of the overall economy. Now, to put that in a personal context, imagine the biggest cost in your daily life, perhaps your mortgage, perhaps your rental payments, growing 3 times faster than what your income is likely to grow for over the next 2 decades. You would know that that's not sustainable and that you have a real challenge ahead. Now, the problem that the aging population poses is made worse when you consider the fact that all across the world, debt levels are already at their highest on record. So we do not have any savings in place to pay for this expected spending going forward. Now, debt isn't necessarily a bad thing, but in this case it is, for the simple reason that what we're borrowing is rising at a far faster rate than what we are producing. And in essence, that means that we're basically getting poorer. Now, back in the year 2000, global debt levels in US dollar terms had hit $87 trillion. By the time the GFC hit, which was caused by too much debt, that number had hit $142 trillion. By the end of 2014, debt levels were another $70-odd trillion higher at some $200 trillion, or nearly 300% of global economic output. And this problem is affecting all sections of society, not just governments, who've been on an unprecedented spending spree in the last few years, and who are now so cash-strapped they've resorted to printing money to pay their bills, but households too, who all around the developed world have had to go deeper and deeper into debt for the past 3 or 4 decades, and who now find themselves financially stretched. So when you sum this up, there's no question that in the next few years, there's going to be a major slowdown and further uncertainty in the global and Australian economy, because we cannot keep borrowing more than we produce. Now, that's not something we can't manage, but sadly, in all likelihood, it is going to mean higher rates of unemployment or underemployment, lower wage growth, and less disposable income for most people. Obviously then, that's going to limit the ability of companies to actually grow the volume of goods and services that they sell to us as consumers, which will mean lower company profitability, lower investment, and in all likelihood, lower real asset prices. And with financial markets already dangerously overvalued in many parts of the world, there is going to be a significant rebalancing between financial assets and real assets. And to help visualize that for investors, you want to consider that in global markets today, out of every $100 that is invested, some $99 is sitting in investments like the stock market, the bond market, and just traditional cash, all of which face huge challenges in the years ahead. Only $1 is currently invested in real assets like gold. So there is a huge potential for money to flow from overvalued financial assets to undervalued real assets. And that is why some of the most successful money managers on the planet today are investing in real assets like gold. These are people like Ray Dalio, who runs Bridgewater, the world's largest hedge fund, or Stanley Druckenmiller, whose Duquesne Capital went more than 2 decades without ever losing money in any given year, including the GFC when most people's portfolios fell over 30%. He now has more than 20% of his own money invested in things like gold. These are just 2 examples of this group of highly successful investors who can see what's happening in the real world, and they're now de-risking their portfolio, taking some money out of financial assets to buy things like gold and silver, investments that are accessible to people of all wealth levels, whilst other people are looking at more boutique real assets, things like fine art, diamonds, and agricultural land. And that is because these are the types of assets that are going to be highly profitable in the years ahead as the world goes through its inevitable challenges and financial market rebalancing. For those looking to protect and grow their wealth in the coming years, it's critical you pay attention to these trends.
So what have I done personally? So right at the start of this journey, we were looking to put more money into shares and more money into property, and since then we've stopped. In fact, what we've done is we've done the opposite. We've actually sold some property and we've moved all of our shares into cash. We took all of our superannuation from an equities to defensive positions of cash, and then I set up a self-managed super and I managed all of that money myself. The assets that we have within self-managed super at the moment are very defensive, so strong cash positions, we hold some precious metals and also some sophisticated hedge instruments that will increase in value should the market collapse. I think that financial literacy is really, really important, and not only is it important for the average person, but it's really important to be able to teach our children the value of financial literacy. So I think the one thing that I would offer advice on is it's something that you really need to take seriously. So I think the real defining moment for me was I came across this wonderful quote from Pablo Picasso, and that was, your purpose in life is to figure out the one thing that you're really, really good at, and then your mission in life is to give it away for free. So we got to a point where we were relatively comfortable, but then we figured out what then. And for the longest time, I was trying to figure out, what's my purpose and what's my mission. So I want to be able to help people. We're not selling anything. We just want to be able to get a message out that financial independence is really nice. Financial literacy is important in order to be able to become financially independent. And hopefully this gets out and people will benefit from it.